Hi, everyone. Welcome back to another session on strategic financial management. Today's topic is cost accounting. I'm going to give you a brief introduction to cost accounting, and I'll also be giving you the definition of certain terms that we will be using throughout the module related to cost accounting. So today is going to be an introductory session for cost accounting as well as the definitions related to cost accounting. First, let's move on to the word cost accounting. What is cost accounting? So as I always do the thing where I'm going to break down the word into two, or the phrase into two words. So here we have two words, one cost and the other one is accounting. So what is cost? What is cost? Can anyone tell me? What do you mean by the term cost? If I ask someone, what is the price of the product? Or what is the cost of the product? You will have an answer. So what is cost? Cost refers to the monetary value of the resources consumed in the production of goods or services. When you're planning to produce or manufacture a good or a service, there are certain costs involved. Now, this is called cost. You need to spend money, or there are expenses that is related to the manufacturing of the products of goods, production of goods or services. Now, this is known as cost. There are different types of cost. We have direct cost, indirect cost, fixed cost, variable cost, semi-variable cost, opportunity cost, and you'll be learning all these costs in detail. And now let's move on to the word accounting. What is accounting? We learned this last week. Accounting is a process of systematically recording, analyzing, summarizing, and interpreting the financial transactions or financial information of the business. So now let's combine the words cost accounting. What is the meaning of the term cost accounting? So Sima defines cost accounting as the establishment of budgets, standard costs, and actual cost of operations, processes, activities, or products, and the analysis of variances, profitability, or the social use of funds. Now, cost accounting is the process of recording and analyzing the costs associated with producing goods or services. The primary goal of cost accounting is to understand and analyze what are the expenses incurred in producing the goods and services. How can we control them? How can we make informed decisions related to these costs? This is cost accounting. This is cost accounting. Now let's move on to a few definitions. These terms are very crucial, and I'll be using these terms throughout the module. So I'm not going to give you the definition every time I use these terms. So make sure that you understand the meaning of these terms. You get what it means, because I'll be using these terms in the future while I'll explain the other concepts in cost accounting. Yeah. Number one, cost center. Cost center defines it as a production. Sima defines it as a production or service location, function, activity, or item of equipment whose cost may be attributed to cost units. To enable the allocation of cost-to-cost units, it's important to categorize the factory or industry into distinct segments. Right, what do you mean by a cost center? Now, a cost center, it's a department, unit, you can also call it a function within a company that is responsible for incurring costs, and they do not generate revenue directly. That is the reason we call this a cost center. So a cost center, that can be a department, it can be a unit, or it can be a function within a company. Right? So cost centers, they're important in cost accounting because they allow businesses to monitor and manage their expenses, leading to better budgeting and cost control. Now, there are different types of cost centers. We have production, service, administrative, and selling and distribution cost centers. Now, here, I've given a few cost centers or departments. So cost centers, you can also call them departments. We have HR department, R&D, research and development, marketing department, and finance department. Now, these cost centers, they or rather departments, they come under different types of cost centers. For an example, the production department, or let's say the HR department, yeah? The HR department, they're responsible to training, recruiting employees. Yeah, so they handle employee recruitment, training. They also look into the salaries of the employees, roles, responsibilities, everything come under HR department. And they are related to the administrative cost center. Let me jot it down. So you have 4 different types of cost centers. We have production. We have administrative. We have selling and distribution. And I said something else. What was that? Production, administrative, selling and distribution, and service cost centers. So these are 4 types of cost centers. Now, HR department, they go under administrative cost center. Why? Because they're related to handling employee recruitment, training, and salaries. So this is an administrative cost center. Next, we have R&D, research and development. So it's your chance now. Anyone who knows research and development, which cost center will that fall under? You can type your answer on the chat box, or you can unmute your mic and answer the question. No problem. Quick. Where does R&D fall? What is R&D? Research and development. Yeah, so they focus on innovation and developing new products or services. And again, it does not directly generate revenue. Yeah, so it is associated, or the costs involved or costs are related to research, testing, and developing the products or services. Production. Okay, someone says production. Are you sure? R&D? Production. Okay, everybody says production. And why do you say production? Does it directly involve in production? Or is it a service? Because you're researching, you're testing, innovation, yeah, service, and maybe some aspect of R&D can fall under production. Yes, some aspect of it. Next, we have marketing. Marketing, where does it fall? Now, what is marketing? This particular department involves, or these department, they incur cost related to promoting and selling the products or services.
Selling and
Right. Very good. Selling and distribution. Excellent. That is correct. And finally, we have finance department. Now, you know, finance department is like the main or the center department. Yeah, because they're connected to all other departments. Because for example, if marketing department wants to launch a product or produce a new product, they have to contact the finance department. HR department, they need to get a new employee into their department. They have to contact the finance department. Why? How much are they willing to pay? Yeah. So like finance department is like the center. So where does finance department fall? Which cost center? So we have 4 cost centers: production, administrative, selling, distribution, service. So definitely it is not going to fall under production. Yeah, not selling, distribution, not selling. Yes, administrative. That is correct. Excellent. Good job. Now let's move on to the next part, that is costing. What is costing? Now, costing is the process of determining the total cost of producing a product or service. So here it involves identifying the costs, measuring the cost. What type of costs are these? Now, when it comes to costing, there are various types of costs that is involved in producing the product. So basically, we have costs called direct costs and indirect costs. So this is sort of the basic formula to find the total cost of a product, right? Total cost of a product. Say for an example, to produce a product, 1 unit of product, right? To produce 1 unit of product, the direct cost of producing 1 unit of product is, say, 10 USD. And indirect cost, 5 USD. So how do we find the total cost? Total cost equals to direct cost plus indirect cost. So in this case, it will be 10 plus 5, which means 15 USD. Right? This is called costing. This is called costing. The process of determining the cost of products or services through principles and rules that vary depending on the industry. So the main objective is to analyze financial records and allocate expenses to specific cost centers and to determine the total cost of department, processes, jobs, or contracts for a company. This is costing. And now we have something called the cost unit. Now, what is a cost unit? SIMA defines a unit of cost as a unit of product or service in relation to which costs are ascertained. Meaning, how do we measure? For an example, when it comes to automobile, cars, how do we measure? Number. How many cars? How many cars? Again, when it comes to brick, how do we measure brick? You can say 1 brick, 2 brick, 3 brick. Now, this is called as the cost unit. Again, transport, kilometer. Yeah, chemicals, liter, gallon. So this is called as cost unit. Now, cost unit is a measurement used to express the cost of producing a single unit of product or a service. Get it? This is called as cost unit. And next, we're moving on to something called the profit center. Now, cost centers, as I told before, cost centers are related to what? Cost centers, they are related to basically responsible for incurring the costs, but does not generate revenue directly. But when it comes to profit centers, now same as a cost center, profit center is also a department, unit, or a function within a company, right? What was the definition that I gave you to cost center? It can be a unit, department, or a function within a company. A profit center as well. It is a department, unit, or a function within a company. But the main difference between a cost center and a profit center is a profit center is responsible for both, meaning they're directly involved in generating revenue and incurring costs. Get it? So profit center generates revenue exceeding its expenses through the sale of goods or services, while cost center only generates expenses and focuses on lowering them with a specific budget. So this is a main difference between a profit center and a cost center. But other than that, they're basically the same thing. Get it? So again, a cost center focuses only on managing costs or maybe budgeting, and it does not directly involve in generating revenue. Whereas a profit center, they are responsible for both generating revenue and controlling costs to make a profit. Next, we have cost allocation. What is cost allocation? Cost allocation is the process of assigning or distributing costs to different departments. Cost allocation, assigning different costs to different departments. Cost allocation is a practice of charging costs to cost centers when they are directly identifiable with a specific product or department. Now, cost allocation, when you know this cost is related to this department, then you allocate that cost. Yeah. So say for an example, the rent of the building. So the rent of the building for the building, let's say the rent for the building that you're paying is around $2,000, right? $2,000. And your building has 4 departments. Your building consists of 4 departments. You have HR, marketing, finance, and IT. So 4 departments. Now this $2,000 is allocated among these 4 departments. So you can decide on how you share or allocate the rent among these 4 departments. So you can sort of use an allocation method, maybe look into how many employees are working, or maybe you can look into the square foot. Yeah, say how much, or how, like, this department has this amount of square foot, this department has this amount of square foot, and then you can divide the rent, or you can look into the number of employees. But I just imagine hypothetically that each department has equal number of employees and it's equally divided into 4 parts. In that case, the $2,000 will be divided into 4, which means each department has to pay $500. Now, this is cost allocation. Now, remember, in cost allocation, you know that this particular cost is related to this department or this product, right? You know this cost is related to this specific product or department. You're very, very sure about it. Now, that is cost allocation. Next, we have conversion cost. What is a conversion cost? The term refers to the total cost of converting raw material to finished goods or moving materials from one production stage to another, including direct wages, direct expenses, and overhead costs. So conversion cost refers to the cost incurred to convert raw materials. You bring in raw materials to your production department. These has to be converted, transformed into finished products. While you transform these raw materials into finished products, there are certain costs involved. This is called as conversion cost. So under conversion cost, you can have direct costs, right? Direct labor, direct material. You can also have other costs. You call it indirect cost, or you also call them overhead costs, like rent, utilities, depreciation, right? This is called as conversion costs. And now we have cost absorption, cost apportionment. Cost absorption, cost apportionment. Let's see what cost absorption is. To complete the charge, the indirect costs or overhead costs must be distributed over the final products, known as cost absorption. This process involves the cost absorbed by production during a period. So cost absorption is the process of absorbing, in other words, allocating the total costs of production into the cost of individual products or service, right? So this includes all types of costs, direct, indirect, overhead, everything. So this is called as cost absorption. Cost absorption. So in cost allocation, we will be allocating the cost that is relevant to a specific product or department. In cost absorption, the rest of the costs, right? The rest of the costs will be allocated to the different product, service, or a department. This is cost absorption. Clear? And now we have cost apportionment. Cost apportionment is a method used when costs cannot be directly charged or identified with any cost centers. Now, there are certain costs that you don't know specifically which department should we distribute it to, which department should we allocate. You're confused. So then we use a technique called cost apportionment. Now, under cost apportionment, you're distributing the costs among different departments or products or services in a reasonable manner. Now, in cost allocation, what did we do? We assigned the costs to specific departments. Why? You know this particular cost is related to this department. But apportionment is used when you're not sure, when you don't know which department to assign this particular cost, which department to allocate the cost. Then we use the technique called cost apportionment. And cost apportionment, we use different techniques. As I said before, floor space, number of employees, machine hours or labor hours, right? So we use an apportionment method. For example, apportionment, let's say, I can give you an example. Say for an example, related to, let's say machine hours or labor, or let's say labor hours. Okay, when it comes to production department, you will be paying your labor depending on how many hours they worked. Cost apportionment. Right? So in a summary or in a nutshell, cost apportionment is the process of dividing indirect costs among different departments, functions, products, or services of the organization based on a reasonable method. So usually you use a prorated or distributed method among cost centers on a predetermined basis. I can actually do a calculation on how this is done. The cost apportionment method. I can explain you how these calculations are done and how they actually do it in a department. Maybe if we do have time after the end of the module, I will be able to give you an example on how this is done. And now we have an example. Now here I'm going to introduce you to the different types of costs. So we have different types of costs: direct costs, indirect costs, direct costs, and indirect cost. Now, what do you mean by direct costs? Who can tell me? What is the meaning of direct cost? What is the meaning of direct cost? Okay, this example. What do you see here? Manufacturing chairs, or let's say furnitures. So what is the direct cost, or what are the direct costs involved, and what are the indirect costs involved in producing this product? Who can tell me? I want someone to explain. It's easy. Right. What are direct costs? Direct costs means costs directly associated in producing the product. Indirect cost means the other costs that are indirectly associated in producing the product. Now here in this case, we have wood, we have fabric or maybe leather, fabric, leather materials. We have someone who's gonna do the process, like the carpentry, cutting, and we do direct material plus labor plus tool machinery. Excellent. Yes. So under direct cost, we have direct materials, meaning the raw materials. These, the fabric and the wood. This is coming under direct material. Direct material. Direct material. Next, we have the person involved in producing the product. The person involved in producing the product, the carpenter. Now, he is direct labor. Why? Is he directly involved in producing the product? Yes. Are these materials directly involved in producing the product? Yes. Tools, painting, nails, nails, paint, varnish, all these come under direct material. So all these costs that you see here, they come under direct cost. Why do we call them as direct cost? Because they're directly involved in producing the product. Direct cost. Now we have indirect cost. What are indirect cost? Indirect cost means these costs are not directly involved in producing the product. Meaning these costs are not necessarily associated in the production process directly. They're indirectly tied up to the production. For example, warehousing. Now your wood has to be stored somewhere. Right? Your wood, your raw materials has to be stored somewhere. The warehousing, the rent that you pay for this particular room, it's an indirect cost. Next, the people who are involved in delivering, transportation, delivery, that come under indirect costs. Electricity, the rent you pay for the building, factory rent, all these come under indirect cost. Indirect cost. So total cost equals to direct cost plus indirect cost. Again, what is a direct cost? What is a direct cost? Costs that are directly tied up or costs that are directly associated in producing the product. Indirect costs that are not directly involved in producing the product. Now let's look into the objectives of cost accounting. Number one, ascertaining costs. Cost ascertainment involves collecting and categorizing expenses that can be directly charged to manufactured products with other expenses allocated based on suitable basis to determine the cost of production. So the first objective is ascertainment of cost. What is ascertainment of cost? Now, this is a process of determining the total cost of producing a product or service. So here you're going to record all relevant expenses, whether it's direct or indirect. You're going to record it. Right? Here the goal is to ensure that the business, that the organization have a good understanding about their costs. What is the cost of the raw materials? What is the cost of transforming these raw materials into final products? So you have to identify our cost. This is ascertainment of cost. Direct material. What are my direct materials? What are my direct labor? What are my factory overheads? What are my fixed costs? What are my variable costs? So this is ascertainment of cost. So with cost accounting, you can do it easily. Yeah. So cost accounting helps you to find out the different types of costs. Number 2, determining the selling price. So how do we set up our selling price? We have the cost plus the profit margin equals to best price or the selling price. Now here, again, there is a problem. If you need to decrease the selling price of a product, you will have to decrease the cost of producing, or you will have to drop the profit margin. Now, sometimes, the shareholders or the owners don't like the idea of dropping the profit margin, because what is their primary goal? To get more returns. They need more dividends for the investment that they make. They need more profit. Yeah, that is their basic goal. Their basic aim is to get more money from their investment, the shareholders and the owners, more profit. So this is something that cannot be touched. So if you try to play around with the cost, again, there are consequences. Why? If you substitute quality materials with low quality materials just because you can purchase it for a lower price, you will lose customers in the long run. So determining the selling price is actually quite a challenge. You bring the cost down, you can bring the selling price down. But if you bring the cost down, this have consequences. Obviously, bringing the cost down means you will be purchasing raw materials at a lower price. Yeah, lower price. If you are purchasing raw materials at a lower price, maybe the quality of the raw materials are low. So in the short run, the business or the business will feel like, okay, we're saving a lot of money. But in the long run, it's actually a cost. Why? You might lose customers. You lose your current customers and potential customers. So it's very crucial. You have to focus. You have to look into every aspect when you make this decision. Again, depending on your target audience. Yeah, because some of the customers, they're willing to pay a lower price for a product. And there are some other customers who are willing to pay a higher price for quality products. So your target market is also important. So when you determine the selling price, when you decide the selling price, you have to look into all these aspects. Yeah. So when you determine the selling price, you will be calculating the total costs involved in producing the product, then add on the desired profit margin, then set the selling price. So when you set the selling price, you have to look into the competitor pricing. What is the market demand for your product? What is the customer perception of the product? So if the customers need products at a cheaper price, and if they don't really focus about the quality of the product, then you can produce products at a cheaper price. You can purchase raw materials at a lower price, even if it is not of good quality. Yeah, you have the option of purchasing low quality materials at a cheaper price and then selling it at a lower selling price. Now, this is only for the customers who want products at a cheaper price. So they don't really bother about the quality of the product. Yeah, but for customers who really or who actually look into the quality of the product, so they don't mind paying a higher price for a high quality product, for those customers, you need to be careful. So you have to purchase good quality raw materials, then produce the final product, set the profit margin, sell the product. So competitor pricing, market demand, customer perception, target audience, everything has to be considered when you determine the selling price. And this is another objective under cost accounting. So now actually, when you really think about it, you can see how crucial and how many steps are involved in making these decisions. It's not easy. You know, one wrong decision, everything is messed. Yeah, everything goes mess. So, for example, you switched the supplier because you are able to get the same raw material at a cheaper price. But later on, during the production, you realize that the raw material is not of good quality. Problem. Yeah. So it's very important. You really need to focus when you make decisions. And you can see the stress that the accountants, the cost managers, people are involved in this are going through. It's a lot of stress. And next we have cost control. Now, what is cost control? Cost control is the process of monitoring and managing the cost of a business to ensure that they stay within the budgeted or expected levels. So that is the reason we have budgetary control, historical costing, and standard costing that help manage cost and assess the operating efficiency of a business organization. What is budgetary cost? What is historical cost? What is standard cost? Now, budgetary control, this refers to the process of preparing budgets for various departments. So we will be creating a budget for each department. Production, marketing, sales, HR, this is their budget. And then you will be monitoring, right? You have the budgeted and you have the actual. So you will be looking to the differences. What is the difference between my actual performance and my budgeted performance? So if the actual is more than your budgeted, meaning if your actual costs are higher than your budget, it is unfavorable. You call it unfavorable variance. If your budgeted costs are more than, sorry, your budgeted costs, no, actual costs are lower than your budgeted costs, this is favorable. Why? You have done some savings. Yeah, you have curtailed some unwanted expenses. So we budgeted more, but actually is less, it's favorable. So if it is unfavorable, meaning your actual costs are higher than your budgeted cost, then you need to take corrective actions. So if there are significant variances, you need to make corrective actions. What can we do to improve the performance? What are our unwanted costs? How do we bring it down? Yeah, so this is coming under budgetary control. Next, we have historical costing. Now, historical costing is a method of determining the cost of producing a product or a service based on actual costs incurred in the past. So we look into the past actual performance and then decide on the costing. Yeah. So historical cost uses actual data from past transactions and then determine the cost of product or service now. This is historical costing. And finally, we have standard costing. Standard costing is, this is a method that is used to determine the expected or standard cost of producing a product. Right? Expected or standard cost of producing a product. Now, standard cost, they estimate the cost based on historical data or forecast. Right? They may also forecast the future and then determine the standard cost. So this is standard costing. Next, measuring and increasing efficiency. Cost accounting involves studying manufacturing operations and service provision to measure organizational efficiency and identifying ways to increase it. What does this mean? The primary goal of a manufacturing or cost accounting department is to make sure that the costs are under control. Right? So they will be analyzing the costs and identify the areas for improvement. Are there any costs that can be reduced? Are there any costs that can be curtailed? Are there any costs that can be eliminated? Now, this is measuring and increasing efficiency. Measuring and increasing efficiency. Right? So by tracking cost closely, organizations can see where there are inefficiencies, where there are waste. Are there any wasteful practices that involves unnecessary costs? If that's the case, they will eliminate it. This is coming under measuring and increasing efficiency. And finally, providing basis for managerial decision making. Providing basis for managerial decision making. What does this mean? This is one of the key functions or key objective of cost accounting. Cost accounting helps managers to make informed decisions about various aspects of a business. For an example, pricing decision. We learned about determining the selling price. We learned about budgeting, historical cost, standard costing, cost control, elimination of costs. Then we also learned about ascertainment of cost, measuring and increasing efficiency. And finally, making or buying decision. For an example, if the business or if a product is running at a loss, are we going to continue the product at a loss? Are you going to continue to sell the product at a loss, or are we going to stop that particular product? So say for an example, one production department is running at a loss. The sales are below the line, the expected line. And there's so many costs. Maybe the expenses are more than the income earned. So are we going to run it at a loss, or are we going to close it down? Cost accounting will provide you a basis for this decision. Next, are we going to stitch it in-house? Are we going to manufacture it in-house, or are we going to purchase products from elsewhere, then modify it, and then sell it? This is make or buy decision. Are we producing the product in-house or buy it from an external supplier, modify it, and then sell it? And finally, related to technology, are we going to use a typewriter, or are we going to use a printer? So this provides basis for managerial decision making, which is cost accounting. Let's go through a quick revision of what we learned today. We learned about cost accounting. We learned the definition of cost accounting. And then we learned the definition of certain terms that I'll be using throughout the module. So I'm not going to explain or, define the term every time I use this term in the other concepts or when I teach other concepts under cost accounting. So I'll just use cost center. Okay, this is a cost center and this is how it goes. So please make sure that you're very thorough with the definition, because when I use these terms and if you don't know the meaning of it, it's very difficult to understand the rest of the explanation. So make sure that you have a thorough understanding of all the definitions that we learned today before you come to the next class. And then we learned about costing, cost unit, profit center, cost allocation, conversion cost, cost absorption, cost apportionment. And we also had a detailed study about the different types of cost. And then we learned the objectives of cost accounting, which is ascertaining cost, determining selling price, cost control, measuring and increasing efficiency, and providing basis for managerial decision making. And then again, having said that, these are few objectives of cost accounting. You have many more, but I only taught you some of the basic objectives of cost accounting. All right. Thank you so much for attending the session today. I'll see you all next week. Have a good week ahead.